Assalamualaikum and hi doctor. I'm Wan Muhammad Zanas bin Mazukifli with matrix number 291613. Today I'll be presenting my study on Bank of Communications in Republic of China for its performance and determinants. Thank you for lending me your ears. To begin my analysis, let's look at the background of the subject. The Bank of Communications, or BOCOM, is not just any financial institution. It is a pillar of the Chinese financial system. Founded in 1908, it is one of the four oldest banks in the country, maintaining a reputation for stability and respect over its long history. Today, BOCOM provides a comprehensive suite of services, including commercial banking, securities, trust service, and insurance. However, even a giant like BOCOM faces significant headwinds. Our study is motivated by a critical problem statement. I have observed an erosion of governance and transparency within the institutions, coupled with a period of chronic underperformance that some experts are calling an inefficiency crisis. Furthermore, there is a high exposure to macroeconomic and systemic risks that threaten the bank's asset quality. Under the leadership of current chairman, Ren Deqi, addressing these internal and external pressures is paramount to bank's futures. Guided by this challenge, my research is structured around three primary objectives. First, the aim is to determine the specific impact of the return on asset, or ROA, as a primary measure of performance. Second, isolating and identify the external macroeconomic factors that dictate BOCOM's performance in the Chinese market. Finally, the third objective is to investigate how both internal governance factors and external market conditions interact to influence the overall success of the bank. Before we dive into the data, it is essential to ground the study in established financial theory. According to Johans 2019, the ultimate objective of any corporate activity is profitability, specifically measured through return on equity. As the saying goes, a firm that is yet to realize profitability is a corpse. For primary metric, we lean on Smith's 2023 definitions of ROA. Smith argued that ROA is the key indicator of management competence, showing how effectively an asset base is converted into earnings. Need also to be considered is credit risk through the lens of average collection periods and corporate governance as the set of rules and procedures required to achieve successful strategic implementations. These theoretical frameworks provide the foundation for the variables that test in the modules. How did I conduct this study? My methodology involved a quantitative analysis of financial data collected from BOCOM's annual report over a 10-year period, specifically from 2015 to 2024. I've developed three distinct regressions models. Model 1 focuses on internal factors, Model 2 looks at external factors, and Model 3 combines both to see the broader picture. All data was initially processed in Excel for trend visualizations, then subject to ordinary least square multiple regressions using SPSS version 27 to ensure statistical rigor. Now, let's look at the data. On this slide, you see the descriptive statistic for the 10-year period. The mean return on asset for BOCOM was 0.0071, which translates to an average return of roughly 0.72% for every dollar invested in asset. The standard deviations for ROA was quite low at 0.001, which tells us that despite the efficiency crisis mentioned earlier, the bank's asset profitability has remained relatively stable and reliable over the last decade. I also tracked variables like liquidity ratio, inflation, and GDP, which we will now see reflected in correlation analysis. The correlation metrics reveal some very clear relationships. Most notably, we found a significantly positive and strong correlations between ROA and ROE, with a coefficient of 0.912. This confirmed that asset efficiency and shareholder returns are moving in lockstep for BOCOM. Conversely, I found a very strong negative correlations with firm size at negative 0.965. This is a critical finding. It suggests that as the bank grows larger, its return on asset tends to decrease. This likely points to the operational complexities of these economies of scale that often plague massive financial institutions. Moving to regression's result, Model 1, which focused on internal factors like the corporate governance index, credit risk, and firm size, showed an incredibly high R-square of 0.998. This means that nearly all the variations in ROA can be explained by these internal management factors. The ANOVA table confirms this with a significance level of 0.006, meaning Model 1 is statistically significant. Interestingly, while the external factors in Model 2 like GDP and inflation were relevant, the model as a whole did not reach the same level of statistical significance as the internal management model. When we look at the individual coefficients, the story becomes even clearer. In Model 1, firm size has a significant negative influence. As the bank expands, the operational complexity grows, leading to smaller marginal returns. On the external side, factors like GDP and the exchange rate contribute positively to the ROA. This indicates that while internal governance is the primary driver of performance, the bank still benefits significantly from periods of national economic growth and favorable currency environment. In conclusion, my study identifies that while factors like regulatory capital and liquidity contribute positively to performance, the sheer size of Bwrrk has become a double-edged sword, leading to diseconomies of scale. To address this, I propose 5 key recommendations. First, strengthen the reg cap base. We must prioritize a robust regulatory capital base to mitigate systemic risk. Secondly, maintain a GSIB status. Bwrrk must ensure capital adequacy aligns with global standards to protect its market positions. Third, empower risk committees. We need to enhance corporate governance to better navigate both internal distress and external macro volatility. Fourth, cross-functional synergy. We recommend integrating interest and credit risk management across all 2,800 branches to address the shrinking ROA. Finally, stricter management duties. The board must enforce rigorous accountability to restore transparency and governance. By focusing on these internal improvements, Bwrrk can turn its efficiency crisis around and ensure long-term stability. Thank you for your time, Doctor, and have a good day.